Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty, and I'm doing our housing weekly market update. And we've got a lot of things to cover today. I'm actually going to bring in Barry Habib, who I always talk about. He was on a show recently. He's not going to be actually on here, but I'm going to play something that he was talking about on a few subjects. Some of the things that we hear a lot about right now, back and forth, rather than just hearing from me all the time, I thought it'd be great just to have him come in and see this back and forth, these questions from a younger person who has concerns about the housing market and what's going on. And one of the podcasts he was just in recently. So I'm going to start here by sharing my screen. And let's go ahead and jump right in. Let's get rid of that. Let's go over here. Let's not jump ahead yet. So first, I want to dispel a few things with some of the articles that are out there right now. Keep in mind, please, there is so much clickbait out there. There is so much doom and gloom out there. It is just something else. Um, we're gonna talk about this. Barry Habib's going to get into it a little bit in one of the clips I'm going to show for you, but um, this is actually pretty relevant, and I even ran it by Logan Motoshami over at Housing Wire personally, so we could get his take on it. And he said, "Yeah, because he tracks his stuff daily. We call him the Chart Daddy, just to nerd out. But he tracks his stuff daily, by the minute. He puts out a weekly tracker on all this stuff, and it says only. This is from Redfin. Again, could take it with a grain of salt, but they do have a lot of the data, and it says only 28 out of 1,000 U.S. homes changed hands this year, the lowest turnover in decades. Okay, so when it comes to this chart, he says, of course, turnover is low right now. But when we look at the Phoenix market, it's interesting because we're actually having more sales this year. We kind of overlapped a little bit at the beginning of the year around February, and we actually started out below in January for the number of actual sales, home sales. But we're actually climbing up over last year. We're running at right around almost, let's see, just over 73,000. Let's see, about almost 74,000 now when this comes out. But that is actually way over last year. Last year, let's see, by the end of the year, we were at almost 72,000. Now it's lower than it was in 2023. So for our market, we're actually seeing, an increase, which is good. Um, but I just thought, dispelling this a little bit, take it with a grain of salt because it's kind of bringing in all property types from everywhere across the country. And some areas are going to have, more turnover than others and less turnover than others and so much, so on and so forth. But this is saying, this is the lowest since the mid 1990s as far as sales across the country. But in our area, sales are actually up. Not saying they're a breakout, but they're actually up. Okay. Um, Here's another article I wanted to briefly go out. You may see a lot of stuff out there right now. National Association of Realtors did a survey, and surveys usually a lot of times are junk. And I would say, even though I'm a part of the National Association of Realtors, this is a junk survey. And the reason is they actually sent this out to about 170, is it 170? Let me see my show notes here. 173,000 recent buyers, 6,000 responded. And it was a 120 question survey. Okay. So about 3.5% responded, 120 questions. That's probably part of the problem right there. But these first time home buyers, it's saying follow historic low, and again, Logan Motoshami, Barry Habib, they kind of address this too, with the fact that it is not to say the affordability is not tough, but when you have household formation, two people together, that's how they're able to actually purchase a home right now, along with the buy down rates, especially with new builds and even with resale homes. There are assumable mortgages out there, but a lot of times the first time home buyer is not going to be able to do that because you need a lot of cash to do an assumable mortgage. So right now, a bigger thing are the buy down rates and the arms. And Barry Habib's actually going to touch on this here in a second. It's not the arms like we had back during a crash. Okay. These are much different, and he'll kind of talk about that. You'll even see somebody talking about it who has no idea what they're talking about. But you know, when we look at other data sources for this, and the way it's tracked, uh, this number would be higher. It's probably closer to around 30%. Okay, and the median age, again, you got to, when you're dealing with medians, kind of got to be careful with the median thing. But it's probably closer to 30 to 35 is probably more of a normal number according to my sources. So take it for what you will, believe what you want. Affordability is definitely an issue. Nobody's saying it's not. Insurance is gone up just like everything else, along with the interest rates. Although the interest rates are down now, your out of the box mortgage right now is going to be almost $300 cheaper than it was last year at this time, or even more. But even since the beginning of the year, it's down about 290 bucks. So that's good news. Another thing I wanted to point out was the foreclosures are going up. Actually, they have gone up since COVID, of course, but when you look at this was the crash years. Of course, they were way up then, and you had people that were not just selling houses, they were losing houses and not buying anything. And you had, before you had pre-qualified mortgages, things were much different. People didn't have as much equity. People now are equity rich. Almost half people in the country own their homes outright. Most people have at least $300,000 in equity in their home. Totally different picture. But when you take into consideration where we are right now, we're actually at about 20-year lows. So again, a nothing burger. There's a lot of clickbait out there. You got to be real careful what you're listening to and what you're taking in. This is another one. Um, the old buy versus rent rule is officially dead, according to Yahoo Finance. We break it down. Again, I brought out, and I'll tell you exactly what he said. I brought out Logan Monashami on this one, and I asked him directly. I've got a way to message with him. And he said, home buying articles are useless and nobody ever follows any models. And he's really big on models. Obviously, he's an economist, meaning that, different parts of the country are going to be different. Everybody's situation's different. And they're trying to say in this article that, the new average across the country, it's going to be more in certain areas, like if you're in San Francisco or whatever. They're trying to say that, if you're going to live in a house for 7 to 9 years, it might be worth owning versus renting. And the average has always been about 4 to 5 years. And that's basically what we try to tell people. If you're not going to be in a place for 4 to 5 years, don't buy a house. Pretty simple, right? It's more of a long-term thing. But homeowners are 44 times more wealthier than a renter. Okay. And it's not a one for one, which you're going to see Barry Habib talk about when you talk about increases in your incomes even. Okay. So the well, let's jump right in before we get into interest rates and everything. Let's jump right in. He was on the Patrick Bet David podcast, and here's what the conversation was like.
Like the number of votes that Cuomo got. I'm not saying that people are coming to the polls saying, "Oh."
By the way, they were talking about Mondami winning the mayoral race in New York. Just to sum it up, it's going to be good for a lot of different places, but especially Florida real estate, Connecticut, different places like that, even Phoenix. A lot of people are figuring, people are going to be moving out of there. You may even see some shifts in not only a lot of businesses, but a lot of Wall Street firms and stuff. People are talking about long term, depending on how bad the crime and business climate get. So we'll see how far he can get with some of the communist stuff he's going to try and do. That's totally against capitalism, which is why people are talking about these sorts of things. Free rent for everybody and all that sort of thing, which never ends well. Hopefully they can keep food on the shelves. But anyways, yeah, if you learn the history of communism and socialism, it never goes well for the common person. Not to say that we don't have people taking advantage of the capital markets, but you don't even want to go there when it comes to communism or socialism. So anyway, let's jump right in here.
Oh, yeah, I think it was hold my nose, and it's not about the FOMO. It's
I've
about
got it sped up too, by the way.
Yeah, but this is gonna be bad for Florida. I mean, there's only 220,000 open homes for sale right now, and then there's 385,000 millionaires in New York. Like right now, it's insane. Like look at $1 million house down the street from here, or any average looking house, it's like $1 million, and then for 500,000, you get a concrete box. So no, I think it's like between cutting rates and this, it's gonna be a bad situation in Florida for real estate.
Yeah, so you think cutting rates, and so what you're saying is
Yeah,
the market's going to go up, valuation's going to
how
go
could it
up.
not? I mean, it's like every single time we cut rates, price of houses and asset prices go up. I mean, it's like a law of nature.
Okay, so how do you feel about that? What do you think about what we're saying?
I see it differently. I think that across the United States, you have about 67% of people own homes. So prices going up is a good thing. And of the remaining 33%, at least half of those are not in a position where they're going to be truly in even the market to buy a home. The 16-year-old working at Wendy's, God bless them, but they're not truly in the market to purchase a home. And there's many people that would not be in that position. So how much does home price increases impact those adversely? I think look, it's a zero-sum game. Some people it benefits, some people it doesn't. But I think it benefits many more people. It benefits the economy. Look, home price appreciation is a magical elixir because what it does is it creates wealth. It creates equity. In fact, there's a chart that you could see that I brought with me that shows that if you took a look at net worth and what it takes to be in the net worth category, it's probably near the end there, Rob, and you'll see for net worth, there's a couple of things I'd love to show. Last slide, Rob. If you pull that up, you can see what it takes to be in the top tier in the United States. You need top 1% as big number, 11.6 million, and you can see the tiers. But the real key factor is 2/3 of all net worth come from home equity. It is very hard to create wealth without being in the real estate game. And the average homeowner's net worth is 44 times that of a renter. Now, let me tell you, as somebody who's lived through downturns in real estate, I know people whisper and people say, oh, we need prices to come down. That is a very, very difficult scenario to go through. Because from a mortgage side, you can't get a mortgage easily because the appraisers put something called the negative time adjustment. So you say, okay, I could do it with 5% down or 10% down, but the appraiser says this property is going to decline because home prices are coming down. So you need to put 15%, 18%, 20% down because we're anticipating the price to decline. Makes it very, very difficult. Lenders tighten up. The whole market seizes, and then people don't want to buy a home if they see prices coming down. They're afraid. It's just like the stock market. People buy more stocks as it's going up. People should be buying when it comes up. They don't, right? It's the only things that when they go on sale, people don't want them. There's real estate and stocks, right? So what happens is that psychology, it materializes through the economy in general, and it slows the economy dramatically. And then think about home equity. Home equity is something that is also magical. You can pull on it. You can pay off your debt burden. You can invest with that money. When you sell your home, it can be your retirement plan. So look, while I completely get what you're saying, and you're 100% right, we don't want runaway appreciation. But I think to see prices come down would probably be worse than that.
Well, we're not in a sustainable place right now where it's like, we talk about all the time in the 70s, it was 2.5 years of an average salary to buy an average priced house. Today, it's like 8 or 9 years of an average salary to buy an average priced house. And I see what you're saying about the 65% that own houses in the country, but I think you're overlooking the core part of the economy, people ages maybe like 20 to 40 who are looking to buy a house who, I mean, it's a stretch to buy an average priced house right now for a lot of those people. So is that a healthy place to be in where the core of your economy, like the young to mid-age people can't afford to buy a house?
It's clearly a problem because what has happened. So you're right there. It's clearly a problem because it used to be the median age of a first-time home buyer was between 32 and 33 years old. Today, that's gone to 40.
Yeah.
However, there's only 3 levers you could pull for affordability, right? This is not a magic formula. Prices come down, which I just explained why that's not good. The second is interest rates come down. And remember, we have had quite the shock going from very low rates at around 3 up to 8, now back in this, let's call it 6.5-ish range, 6.25. So, there's been quite the shock there, along with prices rising. The third is time. And the reason why time is because incomes do rise over time. You don't need all of your income.
Pace, though.
You don't need it at the same pace because you don't use 100% of your income. You can't do the simple mathematical equation and say, okay, so incomes are rising at 4.6% to 4.7%. We just got these numbers this morning from ADP. And home prices are rising at the same level, so you're not gaining ground. You are gaining ground because you only use 1/3 of your income. So that additional disposable income actually helps you gain traction. The math isn't a 1-for-1. If you get, for example, 2% rise in income, you can withstand a 4% price rise and still be neutral because of the relative difference, and you don't use all.
You're talking about like the time decay of the mortgage where you're paying less over.
No, it's just that when you figure out your allocation of your income, you're only using let's call it 30% of your income to purchase a home on your mortgage or home payment. So you don't need you get 5% gain on overall income, that's more than what you need for the increase in home value.
Yeah, but I mean, how do you apply that to like back in the day though, where like I said, it's 2.5 times your income versus 8 times your income?
Okay, so
You don't get as much house as you used to.
But you always have to be careful when dealing with medians. Medians is a very dangerous game to play because once again, if you look at median income of everyone, that's one thing. But if you say of those who are actually able to buy a home, let's exclude the 16-year-olds, let's exclude the 19-year-olds, then the median income becomes much greater when you say those who are actually qualified. I'm completely in agreement that affordability has gotten worse. What I'm saying is there's a lot of clickbait out there that make the picture look a lot worse than it truly is.
All right. So let me go maybe to this question here that we got from Yahoo Personal Finance. Is now a good time to refinance your mortgage, right? With everything that's going on with interest rates. You're hearing Lisa, who is coming out saying, Lisa Cook signals that rate cut is not a foregone conclusion, whether they're going to do it or not. Rob, I think you got this clip as well to play by Lisa. But in regards to refinancing your mortgage today, I'm going to read this story to you and then I'm going to come to you. This is from Yahoo Personal Finance. Is this a video, Rob?
Yes.
Okay, play this clip, then I'll read the story, then I'll go to Barry. Go ahead.
We got some breaking news from Washington Fed Governor Lisa Cook, who is speaking in D.C. Steve Leisman has those headlines. Steve.
Thanks, Brian. The outlook for Fed policy continues to be somewhat confusing, with Fed officials offering different forecasts from each other, and even some officials taking both sides of the argument. Lisa Cook, speaking in Washington, said that she supported the decision to cut rates last week, but says downside risks to employment are greater than upside risks to inflation. However, she says the current restrictive policy is appropriate given inflation above the 2% target. Every meeting, she says, including a December meeting, is a live meeting. Meanwhile, San Francisco President Mary Daly said the Fed needs to bring down both inflation and support the job market.
We need to continue to put downward pressure on inflation and keep our policy modestly restrictive, but not hold the reins so tight that we injure the labor market unnecessarily and give people lower inflation, but fewer jobs.
Okay, so is this, I thought it was going to be just going straight to the clip. Is this a good time for me to refinance my mortgage today?
Yeah, it's an excellent time if it makes sense from a rate perspective. For the last 3 years, two things have happened. People have taken out mortgages at higher rates, but also approximately 59% of them, when they purchase a home, they use something called mortgage insurance because they put less than 20% down. Now, thankfully, we've had home price appreciation. One of the great things about it is now you could refinance your home to a lower rate, you could save the delta in rate, and then you could either reduce or remove the mortgage insurance, which means that you can actually save hundreds of dollars. Most people don't look at the mortgage insurance savings that they could get also in conjunction with rate. So yeah, I think it makes an enormous benefit if you could save $300, $400, $500 a month to refinance that. It's real money. And for those people who say, well, maybe I'll wait because rates will come down. I do think rates come down as well. Okay, nobody knows for sure, but I think there's reason to believe we will see lower rates on mortgages. But if you wait to get that extra $30 or $40 a month, it means you're losing the $300, $400, $500 a month savings you could be taking advantage of now.
Got it. Okay. So, and then the other question I'm going to come to you is this one. Risky loan from housing bust era is making a comeback. Okay. If you, Rob, is this a clip that goes into it? What's this clip about, Rob? If we,
This is another Yahoo Finance clip.
Is it immediate getting into it? Okay, go ahead and play this clip. Yeah, this is good.
Well, adjustable rate mortgages, which fell out of favor in
Yahoo Finance, guys. Yahoo Finance.
aftermath of the financial crisis, are catching on again. Here with the story is senior housing reporter Claire Boston. So Claire, to start here, what exactly is an adjustable rate mortgage?
Hi, Allie. So as the name suggests, an adjustable rate mortgage, the interest rate can change over time. Typically these days, you get either a 5, 7, or 10-year period where you have a fixed rate on your mortgage. And then after that period expires, if you're still holding that mortgage, the rate will start to adjust based on the prevailing market rate. So that means it could go higher, it could go lower. In exchange for taking on that extra interest rate risk, you can often get a lower rate than what is available with a 30-year fixed. Right now, 30-year fixed rates are 6.3, 6.4%. Adjustable rate mortgages will be around 5.8% for that 7 or 10-year period. So there's savings there if you're willing to kind of stomach that risk.
Okay, so if you want to pause it right there. Now, this is not no income, no assets.
No, she's got it all wrong.
Okay, tell us.
She's got it all. So she's thinking about negative AM. Like you said,
Right.
Those are the risky types of loans. And then the risky underwriting guidelines are exactly what you said. We're not verifying income, asset, down payment. So she's got it wrong. Adjustables, the only reason they went out of favor is because we had an inverted yield curve. The Fed raised rates so much that now you have an inverted yield curve where shorter term rates were above long term rates. Now that the Fed's been cutting, longer term rates have come down, but now you have a spread between them. So the reason why we've seen a doubling in the amount of applications on adjustable rate mortgages is because they make sense. As she said, you do have a savings. Right now, 0.5%, 0.5% for 7 years. A 7-year fixed period, that amount of savings, if you consider that, it's significant. For example, on a $500,000 mortgage, you'd save about $18,000, $17,000 in the first 7 years guaranteed. But what nobody looks at is, this is something that people should look into, is a lower interest rate mortgage like an adjustable would have compared to a fixed, it amortizes more rapidly in the first few years. So you pick up another $5,000 in equity amortization. So now you've got a significant sum of money, let's call it $22,000 guaranteed in the first 7 years. What happens after that is what people worry about. And everybody looks at worst case scenario. But that's betting against something that is very, very improbable. Could it happen? It could. However, what's more probable is that you look at, let's say, a 40-year history, and let's say that rate goes to somewhere around 7%. 6.96 is the 40-year history of where a fully indexed, meaning what it would adjust to, rate goes to. In that particular case, you would never eat into the savings of the first 7 years. So I believe it's a very good option to look at. And it shouldn't be something that is vilified, like she said, oh, risky mortgages, if you could stomach it. This is something that really can make sense and get somebody into that home, help that affordability issue, because that's the key. Get there so you can create some of that wealth.
Tom, where are you at with this?
Well, I'm with Barry right now, and it's actually a little bit wider. So I'm glad he was a little conservative in his 5/8 of a point. It's actually 3/4 of a point to a point. Right now, 5 and 1. What that means is you have one interest rate for 5 years, and one time at the end of the 5th year, you have to now reconcile, and your bank will send you a notice, and you change your interest once. Not negative amortization, not any of the negatives that go with it. Or 7 and 1. You have 7 years, and one time it adjusts. Those are adjustable rates. Really, I've always felt that you need to make clear, but they're looking for clickbait, they're looking for views, they're looking for their news. Oh, the arm is back, the terrible arm is back. No, it's not. And right now, we are looking at a 70% chance. And remember, Lisa Cook, when she took time away from defending herself for having 3 primary residences, in a little action that she's got with the federal government, is sitting there talking about this. The dot plot right now, which is one of the measurements of the intent of the Fed, has us at a 1/4 point for December. And there's the CME Fed Watch tool this morning was all the way up to 70% chance, up from 61% chance 1 week ago at the time that the Fed spoke. And so it looks like we're going to get another 1/4 point. So right now, Pat, people could be looking at the opportunity to get a 5.0% 5-year ARM one-time adjustment mortgage that makes getting into a house much easier. And if you have the discipline to say, hey, I would have been paying about another 700 more, I'm going to save that. Now you're saving.
Or apply it towards principal. Or apply it towards principal.
Or make the payment anyway. You can do that. Hey, set it up for my payment and take another 500, apply it to principal. This is how people can now look at home ownership, not just do what can I barely afford and get into, but a sensible thing. Now, I 100%. Agree about pricing, and one of the things on pricing is supply, and we need regulation to come down so that builders can build more, because the supply was also what will bring prices down.
Mm-hmm. So a couple of things. Lisa Cook, she pretty much echoed Chairman Powell's thoughts on it's not a foregone conclusion, monetary policy is not preset. So we understand she's just echoing that. But what she also said was that the job market is solid, which I don't know how in the world she could possibly say that. We got the ADP numbers today, and the ADP numbers, if you look at it for this month, it was pretty dismal at 42,000 job creations. However, if you look at the last 3 months in aggregate, and you say, what have we constructed in aggregate, because the last 2 months were negative numbers, there's a grand total of 10,000 jobs in 3 months in the United States that were created. That is not a healthy or solid economy. People that are on unemployment benefit. We got a bunch of charts if you just want to roll through them just real quick, just 1 second on each. So if you go to the second one there, right there. Okay, these are job openings. You can see where the chart's heading on job openings. Then you take a look at the next.
What do you mean by that? Job?
This is job openings.
Job openings. So people are getting jobs. They're getting hired.
Ads for jobs.
Okay.
Now, another thing, Pat, that people don't realize is that the way that this report is constructed is it's not the U.S. government does it in one shot across the board. They go to each state and they say, how many job openings do you have? The reason that's important is because before work from anywhere, if you put an ad in, it'd be a local ad. But now I could put 6 different states where I want an employee. So this is a grossly overstated number. And even while it's overstated at the 7.2 million, it is, look at the trajectory, pretty clear. Next chart shows you once you get let go, look at what's happened.
Guys, did you catch that? Did you catch that? People who are remote workers, that is a huge piece of that. Again, you got to really dig into this. It's not just some quick or AI, let's just throw it together thing. And this is the issue with Powell and Lisa Cook and all the other, people who are, running in the antiquated models at the Fed.
It is harder to find a job. So people are staying on unemployment benefits longer. And remember, in most cases, you fall off after 6 months. So the number is even much worse than this. The next chart shows the ADP report, which we just got today. So you can see the last 2 months were below the red line negative. Today's was above. But when you take the three combined gives you a grand total of 10,000 job creations in the United States. That's unacceptable. We have a very big concern in the labor
You're
market.
making the argument to say lower the rates.
They have to lower rates because we are so
By how much? By 8 point or 2?
So there's a formula for it. There's a formula that says you take the rate of inflation and then you take something that's a little artistic. It's called R star. And Tom knows exactly what I'm talking about. And R star, Stephen Myron, who is a Fed governor, appointed by Trump, he thinks R star is 0.1. You take John Williams, the New York Fed president, he says it's 3/4. Most people in the middle. So even if he said it was 0.5%, okay? So that means that the neutral rate for the Fed funds rate would be at 3.4. So we're roughly 0.5% above neutral. But I think the way that you started at 2.9 is fictitious. And here's why I think when everybody says we're obsessed with inflation, it's too high, I believe that they're absolutely wrong. They don't understand how to read it. Some quick things. Rob, would you mind possibly pulling up the very first chart? And here's the rate of inflation as measured by the Fed. They look at personal consumption expenditure, PC, they look at the core rate, they say it's 2.9, we need it to be 2. It is too darn high, right? But when you take a look, even Chairman Powell says tariffs, they're not inflation, it's a one-time price adjustment. Now, Chairman Powell thinks it could be up to 0.5%. I'm being conservative, 0.3%, so that's an overstatement. Even the Fed chairman agrees that there's an overstatement. OER stands for Owner's Equivalent Rent. Pat, this is the most ridiculous thing out there. And Tom, you know how this works. This is a survey. So a survey, and here's the literal question. If you own a home, the question is, how much could you rent your home for today, unfurnished?
We talked about this last week, guys. I talked about this for months, like a year or two. This is huge what he's going to be covering here, and the fact that they're not counting the jobs data correctly, whether it's politically motivated or not, it's not being done correctly.
And without utilities. Pat, I don't know how much I can rent my home for. Okay, I don't know who does. Okay, and then measure the change month to month. It's insane. But yet this makes up 1/3, by far the largest component in CPI and 14% of PCE. The number that people
and they use Zillow estimates, and Zillow will tell you that they cannot describe how they do the rent conversion. Because you look at how this house for sale would rent for this. They can't describe how they do that.
But they do have good data. So, for example, the survey that the Fed looks at and uses and the BLS uses says rents are going up at 4% a year. This methodology has been in place since 1985 without a change. Now, in 1985, you didn't have Zillow, you didn't have Apartment List, you didn't have Cotality, you didn't have the data from Fannie Mae. All of those things say it's actually sub 2%. But if you take 2%, the difference between 2 and 4, it's enormous because that means that on PCE, we're overstated by 0.3%. It's just a BS number. And then the worst one is portfolio management, and nobody looks at this thing. Portfolio management, if you put your money in with a fund, mutual fund, or with a broker dealer, whatever it is, let's say they charge you 1%. Now, if they went from 1% to 2%, clearly that's inflationary. But if the stock market's going up and you're making more money, but as a result, their 1% is a greater amount, the BLS says that's inflation. How could they possibly say that? Think about it in reverse. Think about it if we had really bad inflation in the supermarket. Here I am, I go shopping, and I look, oh my gosh, all this inflation. And then I come home and I open up my mail and I see my statement, and let's just say in this case, the stock market's tanking. And because the stock market's tanking, my portfolio management fee is less. Now the Fed comes out and says, you know what? There is no inflation because we got the offset from portfolio management fee. I mean, think about the ridiculousness of this. So inflation right now is really at 2%. That's at the Fed's target. So the Fed should get off their obsessiveness with.
Guys, did you catch that? It's inflation is actually at 2%. This is what we went over last week. This is what using these antiquated or political models or whatever they're doing behind the scenes is garbage at the Fed. Garbage.
This silly idea that inflation is too high and they should worry about the job market, which affects most Americans.
Correct. Yeah, but I wonder what percent of this is attributed to the Fed's rates being too high. I mean, don't get me wrong. I think that it's crazy the way the Fed does things. I think they're politicized right now. But we saw this chart on Bricker shows the other day that shows a deviation. Normally, job openings track the S&P 500, but since 2022 they deviated. If you get down to that chart, it shows like half of it shows the job openings that you show. The other half of it shows for the first time that the stock market's going up while job openings are going down since ChatGPT was created. So, do you think some of this, with the job openings being less and less, could be because of automation?
Well, clearly AI is definitely going to continue to have a big impact. We all know all the big headlines, right? So we know that we're going to see AI replace a lot of jobs.
Yeah.
And obviously there's going to be some individuals that are going to be impacted by that, unfortunately, right?
So would a simple rate cut fix the job opening problem? I guess what I'm asking.
What it does is this: it can improve economic conditions. The reason it does that is because if you bring interest rates up, people slow down their buying because people buy with monthly payment, and a higher monthly payment, I'm going to buy less of it. Lower monthly payment, I'll buy more of it. If you stimulate the economy to a greater degree, you may create more jobs potentially to offset some of the losses from AI. So will it stop the AI losses directly? No, but will it offset by economic conditions improving and allowing jobs to be created?
Yes. But what is your solution though? Okay.
Yeah.
So I'm curious, when you look at this chart yourself, that shows S&P is climbing, but job openings is decreasing. How do you process this?
I think we're in uncharted territory here. I think that I'm not a big fan of government intervention, but I'm also not libertarian because I think there are some useful cases for the government. I think this is something that is going to require a lot of thought and attention to avoid like a UBI situation being necessary, because like how do you get around this? Like jobs are becoming more useless. There are a lot.
Okay, guys. So because the dual mandate of the Fed is, full employment and inflation, that's why I wanted to make sure we kind of looked at that and some of the stuff on the ARMs. Again, you don't even have to do the ARMs, but that's an option. There's buy down rates that you can get fixed from day one, or the first, second, maybe third year is bought down. I'm seeing rates, we're negotiating them for new builds, resales as low as 1.99 when you buy a house. Second year, maybe 2.9, and then 3.9 if you're going into a third year with it. And then that's it. It's fixed at that rate. Or you just get, a buy down concessions from a seller a lot of times right now. And we're negotiating that in the deals where you're getting maybe, 100, or 1% lower rate, possibly 2. So, I mean, these things are available. If you want to explore them, I'd love to be able to talk to you about them. Again, assumables are out there. It's just, it takes a little bit longer to do an assumable mortgage, and you have to be a little bit more, you have to have some money to put into that, because you've got to basically buy into the, difference there of what's the person has in the equity. But anyway, the loan officer can go through that with you more. But I hope that was helpful. I tried to speed it up so it wasn't any longer than it needed to be. Let me get out of this here. Okay. So moving on, but that was huge, guys. If you have any questions on that, let me know. The inflation is actually 2%, and the jobs and the aggregate data over the last 3 months, like you said, is actually 10,000 created. So what does that mean? That means the jobs numbers, the inflation numbers are totally different than what Powell, Lisa Cook, and all these other people, Beth Hammock, who's out there. Job market's fine. There's no taming of the market, as far as, demand destruction. There's no issues with it. All wrong, all incorrect, all bogus, all incorrect data. Again, it could be political, it could be ignorance. Powell's not even an economist. So anyways, that's the actual story on these things. A lot of this stuff is just clickbait. So we try to cut through all that for you so you know exactly what's going on. 10-year Treasury today ended at just over 4%. Again, the new model on this is the historic model is going to be about 1.6 to 1.8. That was actually updated from 1.75 to 2. Difference between the 10-year Treasury and where we should be on the mortgage spreads between the 10-year Treasury and 30-year. Historically, it's been around that 1.75 to 2% difference between the two. So this tracks, 10-year Treasury tracks with that 30-year. Now it's right around 1.6 to 1.8 with some updated data. So our mortgage spreads have gotten way better. If they hadn't, we would be much closer to 7% right now, if not over 7%. They've come way down. That's been a big difference in where we are in mortgage rates this year. So that's great news. That means, we're getting better interest rates just with mortgage spreads getting better. Okay. We'll also see if the LLPs, come in from the Fannie Mae. A lot of that's going to depend, on whether or not they go into, out of conservatorship or not. We'll see how that goes. I think we'll still get a portion of that. We'll see how much of an effect there is on the pricing for mortgage rates. Basically, that's just some of the costs associated with your fees and stuff. So that could be passed on to the consumer, which would be great. And then we'll see some of the stuff that Scott Best is doing with the SLRs, which again are some reserves that the banks have to have in order to basically lend money. So, but right today we're at 6.29%. We were, heading toward, we were down near 6.13, heading towards 6 by the end of the year. And then Powell talked, and he talked a lot of ignorant nonsense, which we went in full detail from last week's market report. So if you want to look at that on YouTube and our Facebook page will always have the full clips. If you're on Instagram or you're on TikTok, you're only going to get a portion of that. So check that out on YouTube at Mincola Group or our Facebook page. So right now the average across the country for the 30-year fixed is 6.29. You can get a lower rate than that out of the box from a mortgage broker. Ours is fantastic. It's Evan Einhorn over at Modern Home Lending. He does a phenomenal job. He actually owns the company. So you're going to get much better pricing. You're going to get much better what you're being charged. No junk fees, no processing or underwriting fees. A lot of retail and banks will charge you. And they are only limited to what they have, basically. He has other lenders. He has I don't know, 100 different lenders he can go to and basically shop the best deal for you. So a little bit more on the local market here. Chip makers, the TSMC up in Phoenix to bid on more land that would nearly double its Phoenix real estate. Okay, so we're talking about bidding for 902 acres. We'll start at 197 million, a little over 197 million. And this will be, this will cause more, shops around the area, more restaurants, more real estate, right? So, real estate businesses, they kind of grow with each other. So, when real estate's hurting, everything's hurting. So there's just a quick deal on that. And then I thought this was interesting, so I thought I'd share it with you guys. It's the 4 Phoenix suburbs rank among fastest growing and most affordable in the U.S. And that is Maricopa City at number 9, Buckeye at number 15, and Santan Valley at number 16, and Goodyear at 26 rank among the fastest growing and most affordable suburbs with home values under 500,000. Okay. So that's good news. We're, definitely in the top rankings. So that's great for that. The moving on to the Cromford market. And by the way, I didn't pull it up for you. Purchase application data took another bounce back up. We did not quite where we want to see it at 14 weeks with positive data, but we're getting there. So we'll keep an eye on that. Keep in mind, a lot of that, though, are people who are also listing their homes, but, so they're going to be buyers too. So they get pre-qualified. We always tell our people to get pre-qualified before they list their house. So we make sure there's no issues. That's just one of the things you want to do prior to make sure all your financial ducks in a row. So if those homes aren't selling because things are a little bit slower, with the way the interest rates are, and affordability, or this time of year, although this time of year you have very serious buyers out there who are looking. You may not have as much foot traffic, but you definitely have more serious buyers this time of year who are out looking. So that gives us an idea looking forward 30 to 90 days. Again, working from the lowest levels pretty much ever, but it's a good indicator in the right direction. So the Cromford Market Index, there are local gurus who tell us, where are we at in the market? And basically, we're right now, if we're below 90, we're in a buyer's market. Above 110 is the seller's market, and 100 being totally normal, and within that range is a balanced market. So 100 being balanced. We're at 78.1 So that puts us in a buyer's market all around. Again, that's taking in all of the greater Phoenix area. Supply is up a little bit, 4 points over normal, and demand is down about 19 points from where we like to see that at the balance range. If these two numbers are the same, we're in a balanced market. Okay. I think after the new year, not just because of the seasonal stuff, but I think we're going to see rates come down more. I think we're going to see this shift fairly quickly, not crazy, but I think we're going to see this move back to balance by late spring or summer. We could even be, in a balance to sellers market. Now, the last reports we have for all the cities together basically tell us that this week we were negative 2.1 towards a seller, not much, and negative 2.6 the week before towards a seller's market. So they're shifting back in that direction, but it's not moving that quickly. Again, we got the holidays right around the corner. Things tend to slow down, but you do have serious buyers out there for sure. Okay. Looking at more of the data here really quick. We've got this kind of cut out. Sorry about that, but we're at 81 days closed on market. Right now, our average is right around 41 days to get under contract. Again, taking the whole greater Phoenix area, that we got a 4.23 month supply. That means if nothing else came on the market, that's how long it would take to sell all the properties on the market. With the current rate of absorption at 23, which is actually up a little bit, so that's good. We'll see that in the data here in just a second. The average list price is 750,000. The average sales price is 585,000. And the list to sales price ratio is 97.3. Normally, that number's a little over 98%. But right now, there's a little bit more going in the way of price reductions and concessions. Right now, you want to get a concession more than you want to get a price reduction. You're looking at, a $10,000 decrease in a property is going to give you somewhere around $82 in savings a month versus getting a buy down rate of, let's say, right around or almost 100 basis points or 1%. You're going to be saving, almost $300 a month. So yeah, big difference. So you want to have a strong agent that knows how to negotiate that. Even with a builder, we've been able to do some negotiating with our builder friends who, especially this time of year, are offering a lot of extra incentives. It's a great time to buy. A lot of times people don't want to move this time of year, but this is really the best time of year to get those deals, especially with builders. Okay. Inventory active is down just a little bit, which makes sense for this time of year, almost 1%. And then pending is up 0.7%, which is what we see with the absorption rate here. And closed units is actually down almost 1%. Okay. This number here for the pending kind of tells us where we're going to be in about, right around 30, let's say 30 days. Okay. Normal average escrow is about 30 days. Okay. Cash offers are faster, usually a couple of weeks. They can be, much quicker, but usually around 30 days is a typical escrow, especially when you have a loan. Looking at all the price ranges and price brackets, the days on market, and the percentage changes, and amounts of percentage of inventory. We can break it down even further here from 0 to 599,000. We've got 67%, just over 67%. 600 to a million is at little over almost 19.5%, not quite. And then a million plus is 13.4%. So there you have that. And then let's see, I want to make sure I didn't miss something here. Okay, we talked about the foreclosures. Okay, I thought this was interesting from where we've been. We want to see where we are now. So right now, this is the latest. My screen just went nuts there. Sorry about that. If we look at the latest data, let me bring this down. Okay. Bringing in the latest data for you here as fast as I can. Okay, yeah, it is November 1st. Okay, I thought it was sooner. Okay. here's where we are right now. We're more balanced to warm market right now. Just kind of balance the warm. You do have one little hot area here. This is the contract ratio, what's actively for sale right now, what's under contract right now. This is even a little bit more current than that Cromford Market Index. We are in a hot market in Mesa at 85203 zip code. Beyond that, we're seeing more balance to warm areas. If you take it back just a couple of weeks here, you can see the shades and the colors change a bit, and you can see that we had a lot more cold or colder up here in this range over on the left there. See that, guys? So it's really interesting to see how this has developed over time as the interest rates came down. Okay. That's the big thing. Interest rates came down. So, if you have any questions, guys, feel free to reach out. I'm happy to answer any questions. Even if you're thinking about selling next year, let's talk now. We can get things prepared with the house, maybe talking to somebody in the mortgage world, put together a solution strategy for you so we can logistically get that done. You don't want to wait till the last minute to kind of talk about these things. I know people around this time of year, things slow down. You're not thinking about anything but the holidays. That's great. Love it. Time with family and everything. But if you kind of think ahead a little bit when nobody else isn't, take advantage of some of these things as a buyer this time of year. Just saying, you could end up with a deal. You know, you always want to buy low, sell high, right? Well, now's the time to really take advantage of that, because I think next year, as we learned about in the podcast there, when rates come down, it's not going to be an immediate thing. You know, usually it takes 6 to 12 months for any change to really take hold. But as these rates drop and Powell's reign of terror is over in May, we're going to see some really good things happen in the economy as rates drop. The Fed fund rate drops more. Again, it's not a one-to-one with mortgage rates, but it does have an effect. 65 to 75% of Fed policy, Fed messaging, Fed direction, whether they're hawkish or dovish, whether they're a neutral policy, whether they're an accommodative policy, which we might see some of that. Once we get some real data out there to the markets, markets have gotten much smarter over the last year or two. They're really not. You don't see quite some of this volatility that we used to see. I think you're going to see that values are going to continue to go up over time. I think you're going to see, we just don't have that overwhelming situation that we had back in 2008. So if you're worried about a crash, we're not going to have one. There's not enough inventory, pre-qualified mortgages. People have too much equity, all that. Affordability is certainly an issue, but as those rates come down and we get maybe a little bit more supply from the builders, they're never going to keep up. Okay, that's a fallacy. As we see, some of the regulations further and further drop off from some of these builders, you'll see prices stabilize even more because about 25% of that is made up in regulation. We're going to see an easing in a lot of things, along with energy costs, oil, all that coming down. That's great. And you heard what Barry said. Again, like I've been saying, you look at Barry, you look at trueflation, look at the true indicators of where inflation is, where affordability is, and some of these other metrics. I think we're going to see a great housing market again. So we're here to make housing great again. So if you have any questions at all, feel free to reach out to us, and we'll see you next time.